Hi everyone, and welcome back to another simple daily practice drill that I think you can use to become a better trader. And this one's called the Microgap Reversal. So let's go and take a look. If you've been following my blog posts on Zen Trading Tech, or you've been watching me live in the Brooks Price Action Trading Room, you know I'm always talking about gaps. I consider myself a breakout pullback kind of guy, and if there are no gaps, it's very difficult to trade in this style. In this video, I'm going to outline a reversal setup called a Microgap Reversal. It's very easy to see on a chart. I've also created a free TradingView indicator that you can download by following the link. And as always, the source code is open. You can copy paste that into ChatGPT, and I'm sure it'll code you up an indicator for whichever trading software you use. So here is my blog, Zen Trading Tech. This is the post we're looking for, the Microgap Reversal. You can see it's an indicator for TradingView. I have the link for TradingView that you can go and find. So a microgap is a gap between the first and the third bar of a pattern. Here are three bear bars. There's a gap between the low of this bar and the high of this bar. This is highlighting it for me so I can see it. I did a video and I have a blog post on this gaps indicator, which you can use. What this indicator is detecting is the bears getting a gap below the moving average makes sense. When the bulls get a gap below the moving average, that doesn't make sense. This has a very high probability of getting a second leg sideways to up. Then the bears get the opposite. They get consecutive bear bars above the moving average. High likelihood of them to get a second leg sideways to down. And this is what this indicator is highlighting for us. So I'm going to turn off the regular gaps one so you can see it. If you look at the settings for it, it's pretty simple. You can change your EMA length. You can also turn the arrows on and off. Pretty sure with AI, you could customize it any way you like. But I want to take a look at a few days so you can see how to use it. 14th of April, 2025. First three bars of the day are bear bars with a gap between the first and third bar on a gap up. Now, can this turn into a really strong bull day? Yeah, but usually the daily chart is in an uptrend when that happens. At the moment, we're pulling back in a bear trend, or at least in a bear channel. So this is probably going to be a top. It lights up with a gap. So that means you probably don't want to take the first reversal up. You're able to take a scalp short. And when this one sets up, you've now got three pushes up, four bear bars, selling the low one, looking to close that gap. This was an FOMC day. You can see that the bears were not able to create gaps between three consecutive bars. Here's a gap up and consecutive bear bars. No gap. As soon as the bears are able to create a gap on this first leg down, there's a good chance that this reversal in here is going to be minor. You got a second leg down. Here is a bear day. You can see the counter trend leg did not get a gap between these bars. So it's still a strong leg and probably needs a second leg sideways to up. It was sideways, but it's showing you the counter trend moves are not strong enough to get an aggressive breakout. Looking to sell two-legged pullbacks, especially if they're near the moving average. Here, big gap down, consecutive bull bars. Bull's able to get a MIG reversal here. There's a good looking sell signal at the moving average. Bears will take that. It failed, and the bull's got a second leg up. Now, what about when this pattern fails? All patterns fail, and all failures can fail. Here is a counter trend micro channel. It did get a second leg, but the second leg was from below. That's not really useful for us if we're trying to swing short. This is a good looking sell signal at the moving average. This is follow through of that sell signal. So if you were long for any reason, you need to get out. Gap down, first three bars of the day are bull bars. Good chance we're going to get a second leg sideways to up, and we did. Now here's the opposite. Here is a counter trend leg in a bull day. This should get a second leg sideways to down. It got the smallest of all second legs here. So this is a counter trend signal. And you might say, yeah, Tim, but aren't all reversals counter trend signals? Microgap reversal is an attempt at a reversal. Now what we can't see here is how strong the gaps are for the bulls. When I turn this on, it's going to light all of these up. So you can see it actually comes on the other side of this. Less likely to get a second leg sideways to down, more likely to find a trading range above the 20 moving average, above the 200. If it's 50-50, it's then 55-45. Probably better to be a bull. What about this fun day the other day where we had this crazy 230-point bar? On the open, 3 consecutive bull bars with a gap. This is buy the close, betting on a second leg. This whole leg might even get a second leg of its own. Then on the way down, you've got another set of 3 consecutive bull bars from below the moving average. This is probably going to get a second leg. And again, this indicator is really useful on the open. Big gap down. 1's a good bear bar, 2's bad follow through. You really want consecutive bars when you're selling this far below the moving average. 4 is actually a really good reversal. Why is 4 a really good reversal bar? Because it's miles away from the moving average. So the risk is small and the reward is huge. Probability is low, but credible low of the day. Anyone that took 4, really happy on 5. Everyone that was flat, wish they bought 4. And more importantly, anyone that sold 3 is in trouble. Even bears that sold 3 and sold more above, hoping to break even, there's a chance they're going to take a double loss now. There's your micro gap reversal. Buying here with a stop down there, first target's trading the moving average. Now you notice it didn't light up the bear micro gap here. If I turn that on, you're going to see the red there. Which one looks stronger? The 5 bull bars up or these bars here? It's probably on the bears to lose it. If 16 gets follow through, we can go sideways to down. If 16 is not a good entry bar for bears, there's a chance we're just going to keep drifting up. Bulls want some kind of a channel. 15 doesn't even trigger. 16 is a buy and buy above. Or you can wait to see if we get above the moving average, looking for some kind of a measured move up. Bears tried, they tried again, they tried again. There's probably going to be a give up bar soon. There's your give up bar. So this doesn't necessarily have to reverse the market, but it creates a strong enough counter trend leg to shake trend traders out of their positions. If you're trading and you see that, here's consecutive bull bars, what are your decisions? Do you want to buy the close of that bar, testing this gap? This bar might actually be a sell the close bar. If you're confused, you do nothing. This is bad follow through. This is now an inside bar, which makes it a weak high one buy. It's probably not even going to trigger that buy. 42, 43, probably going to find sellers. Attempt from the bulls 43, still not a great buy. We're probably going to have to go lower. And there's your sell. Another example of it is here with a wedge. We're in a bull channel. We've had a couple of legs up, failed break above, and then 3 consecutive bear bars with a second leg down. This is strong enough itself probably for a second leg. Some traders will sell 6. And as the indicator lights up on 7, expecting a scalp down. Bear's probably going to get out above 11. Another common pattern is the second leg trap. A second leg trap is a strong counter trend second leg that can shake trend traders out of re-entering for trend resumption. Here is a really strong bear spike. We're probably going to create a channel. Bulls got a triggered reversal here, lost money. Bulls now probably got paid on this reversal. They might get a second leg. Now watch this second leg. It's a second entry long, so if you're short, you probably get out and wait to sell higher. So 25 should go up. Now you've got 3 consecutive bull bars. Now for the bulls, they think this is going to be some kind of major reversal. What do bears think? Well, bears see this is a potential double top. Here's a double bottom, probably going to be a double top. Now, often the second leg of a pullback is stronger than the first. So when you're using the microgap reversal, you need to pay attention to the context. On the daily chart, we're in a bear spike down from the moving average. We're always in short. On the 60-minute chart, we're in a bear spike. We're always in short. So the chance of this being the reversal of the year is low. If you got out of your short, you need another sell signal. Now you've got your sell signal. it closes below and covers this gap. So for me, reasonable to sell below 27, or you wait to see if this has one more bull bar and you have to chase. Where's one more bull bar? Now you've got your sell signal. You have to take that. Can you argue you're selling in the middle of a trading range? Yeah, but you're selling in a trading range in a bear spike. And that means odds are we spiked into this range. We're probably going to spike out of it and get a new low. Didn't get a new low on 30. Spike continues. So you need to pay attention to counter trend. Now, what about in a trading range day like this? These gaps are going to show you where the early entry was, but that's in hindsight. So you might have to wait. You see the micro gap light up. You can sell for a scalp. I did take that short on that day, but it often means you have to wait for a pullback and sell later for a second leg. You can see the counter trend moves from the low of the day. There's the micro gap. That doesn't mean hit by the market. It means you're looking for a buy after testing those lows. Now, the final example I want to show in this video is the test of the best entry. So the indicator lights up. Okay, at this point, you're thinking, well, it could be trend resumption. We're in a bull channel. This is not great because we just closed all of the bull breakout and the market rockets away and you've missed your swing short. What this often does is leaves an area for a test. And that means as we come back up to it, if we're lucky, we might get a second chance at it. When bulls come back up to the high of this range, so that's the range, there's the micro gap and it sells off. Now I can wait to see if we come back into that range for a chance to get into that short trade. Now we're testing this bar. Limit order shorts are probably going to start selling somewhere around here. There's your sell signal. That's probably sell to close. Well, thanks very much for watching. I hope you found that valuable. In this video, we talked about the micro gap reversal entry. I talked a little bit about how to trade it, what some of the expectations are, and how I think you can use this in your trading. As always, there's no magic bullets, or if you find a magic bullet for trading, please remember to send me a message because I'd be super interested as well. This is a great addition to your toolkit, and I highly recommend doing some research on this concept to improve your day trading. Thanks very much for watching. My name's Tim Fairweather from Zen Trading Tech.